Hey guys, and welcome to a new video. Today we are going to look at Mastercard. Mastercard is a credit card company competing with Visa and, for example, American Express, but it's less popular than Visa. But let's look if the price is better than with Visa. So if it's a better investment than Visa. First, let's look at the chart. As you can see, it's gone up and it's at its all-time high, which means that we won't get it at a discount probably. So let's look at the financials. First, we look at revenue. Revenue has grown from 10 billion to 22 billion. Net income is positive and has grown from 4 billion to 9.9 billion. The shares outstanding have gone down from 1.1 billion to 900 million, which is a good thing. And now let's look at the cash flow. The cash flow from operating activities has gone up from 4 billion to 11 billion. And the free cash flow is almost the same like with Visa. It's gone up from 4.2 billion to 11 billion. Is it higher than the net income? Not exactly. Yes, it is. Okay, that's a nice thing too. The net debt is 6 billion. I think that's lower than with Visa, but Visa also had bigger income, I think. And the total debt is 14 billion, and with an income of 9 billion, they would only need less than 2 years to pay off their entire debt. Now let's look at their market cap. Their market cap is at 390 billion, which is still very high, so it won't probably grow that much. Then we can look at dividends. Their dividend yield is 0.6% per year, and it's also gone up. And now let's look at price to earnings. The price to earnings is at 38 right now, which is one of the highest. And it would be probably a bit better we're at 25 or 20. But okay. Net margin is at 45%, a bit lower than Visa, but still very high. So you should also be careful about that, even though it's a high margin business. So now let's calculate the value of Mastercard. So first we are going to take the revenue of 22 billion, revenue growth of 5% first, then profit margin in the lowest case 5% would give us 35 billion in revenue in 10 years, which is a low assumption, but it's realistic. Profit margin we go for the lowest of 30% first, and price to earnings we go with lowest 15. This gives us a buying price of $48 per share, but these are really low assumptions, so we'll first increase our profit margin to 40%, which is around the average of the profit margins. This will give us a buying price of $64 per share, and it's currently at 400. So let's increase our revenue by a bit. Let's say 9%. Will make the revenue go up to 52 billion, which will give us a buying price of $94 per share and a price to earnings of 20. So in this case, these are reasonable assumptions, even a bit to the higher side, and still we would not really make a profit in 10 years. So this means the company is, for me personally, a bit overvalued at the moment. But if you think these assumptions are still really low, you could go higher and maybe it would be a buy for you. Let's say we put in 15% per year revenue growth, which would make it go up to 90 billion from 25 billion of revenue, and profit margin the highest is 48%. And in this case, your buying price would be $250, and the price to earnings of 25 would give you a buying price of $322. You could go even higher than that, but it's a bit unreasonable. Let's see how much revenue growth we would need for it to to buy it. We would need around 18% per year revenue growth, which would make our revenue go up from 25 billion to 115 billion, which is really unreasonable, to be honest. So if you think that's still possible, it could be a good investment for you, but for me, it's a buy at 90, around that area, I think. Now let's look at the cash flow model. So the cash flow should grow 17% according to financial bankers, 17% per year. And we put in 17% and 8%, and the rest stays the same, and the free cash flow in year 1 is 11 billion. And their cash and their stock-based compensation is 200 million, even lower than with Visa, I think, 200 million, which is really low. This could give us a better buying price. Net cash, net debt is a bit higher, I think, with 6 billion. 6,000, minus 6,000. And shares outstanding I think 900 million. Yeah, 970 million. So this would give us a buying price of $236 per share, with a current margin of safety of minus 76%. But still, in this case, you would make a profit, a small profit, but still a profit. So if you think, if you agree with these assumptions, it may be a better buying price for you. You could wait for it to go to $236, where was the lowest price. Yeah, $280 was the price after the 22 crash. So I think for me it's even a bit lower than $280, but yeah, you could look more at the stock if it goes down a bit. But right now it's really overvalued, I think. If you like this video, give it a like, and bye.